Well, good morning, everyone. I'm Tim Linville, the Chief Executive Officer of the Construction Employers Association, and pleased today to be able to present to you our affiliate members, Buckingham Doolittle. With them, we have John Swansinger, who's the manager in charge, Steve Domingo, and Rich Fry, to talk to us about building our tax toolkits as contractors, specifically with the employee retention credit and different other aspects of tax issues that affect Ohio contractors. That being said, I'll turn the floor over to you, gentlemen. John, Steve, and Rich, the floor is yours.
Well, thank you, Tim, and good morning, everyone. I really appreciate the opportunity to speak to you today. As Tim said, it sure is a beautiful day out there. It feels hopeful and positive, and we're lucky to be here today. Again, my name is John Swansinger. I'm a member of the CEA, and I lead the construction practice at Buckingham Doolittle and Burroughs. We're a full-service law firm. We have offices and a strong presence in Cleveland, Akron, and Canton. We cover Northeast Ohio extensively. My group handles every aspect of construction law, from the detailed negotiations to the complexities and nuances of disputes. We're involved in those painstaking days of how to get paid, how to get the change order, arbitrating, litigating, planning, settling those disputes, and on and on and on and on. But today, we're going to put all that aside for now, and we're going to be joined by my partners, Steve Domingo and Rich Fry. Steve and Rich lead our federal, state, and local tax team. They spend their days putting money in our clients' pockets. Whatever the industry, Steve and Rich and their team have tried and true results for decades now. From negotiations to winning decisions in the Supreme Court of Ohio, their practice focuses on state and local tax compliance and controversies, including Ohio and multi-state sales and use tax, commercial activity tax, personal income tax issues, and in federal and state tax controversies with the IRS. Steve, for his part, is also our firm-wide managing partner who somehow figures out how to be a great leader of the firm as a whole while staying on the cutting edge of his practice area. Steve started out at Ernst & Winnie over 30 years ago, but soon after joined Buckingham and has been a mainstay of our firm ever since. Steve is a leader, a thought leader, innovative, and fearless. Rich Fry served as the chair of the Ohio State Bar Association Taxation Committee. He has presented his opinions and testified before the Ohio legislature on tax issues. He timely gives tax counsel on business transactions, mergers, and acquisitions. And Rich is the leader of our very busy and determined tax law group. I have to say, I am very proud to bring Rich and Steve to you, the construction employers, to your industry, to share some of their ideas and how they can impact your business. My hope is that Rich and Steve will help you see avenues where you can hold on to more of your money and even get some of your money back. And just a little secret, they won't tell you this, but I will. The tax team at Buckingham sets the standard for hard work and commitment to their craft. We are very proud of this team here at Buckingham.
Thank you, John. And just to save those listening, if you have questions, please type them into the chat box on Zoom, and I'll read them off unless the presenters see them themselves.
Thank you. Ladies and gentlemen, Steve Domingo and Rich Fry.
Thank you, John and Tim. And yes, want to reiterate, if you do have questions during the presentation, please feel free to ask through the chat, and we'll try to address those. And our contact info is going to be on the last slide. So if we don't get to any of your questions, please feel free to email or give us a call. I know Steve and I are both willing to answer any questions you have. So I want to jump right in, and we're going to talk about a couple of federal tax saving opportunities. As John said, we love to put money into our clients' pockets, and that's obviously one of the great ways that we can provide value. And one area that has gotten a lot of press and attention lately is the employee retention credit. This was put in place shortly after the COVID-19 pandemic shut down a lot of the business and commerce that occurred both state and federally. And at first it didn't get a lot of attention because companies that claimed or obtained PPP loans were not entitled to claim the ERC. The Congress changed that in late 2020, and so it opened up the availability of the credit to many more businesses. So it can provide a really significant benefit, especially if you're able to qualify in 2021, because the amount of credit per employee is increased from 5,000 to 7,000 and also applies on a per quarter basis. As in 2020, it's $5,000 per employee for the entire year. There's two standards that we're going to talk about in a minute as to qualifying for the credit. And then the credit is based upon a percentage of qualifying wages. So let's talk about what qualifying wages means. So generally it is, wages paid plus healthcare benefit costs, although it depends upon whether you are a large or small employer. As large employers can only claim the credit on wages that were paid to employees not to provide services. So if you kept people on payroll but asked them not to show up due to the pandemic, then those were the wages that you would be entitled to claim the credit on. However, small employers can claim it on all wages paid to employees. So even the employees that were still, showing up to work and providing services. And the standard on the slide there, note that it changed between 2020 and 2021 as to how you qualify as a small employer. Also, excluded are going to be wages that were claimed for PPP forgiveness and wages that are paid to a majority owner or his family. Want to just have a word of caution. The IRS has put out a couple of advisory notices about these promoter firms that are out there taking very aggressive positions in exchange for a contingency fee. We've been consulted by several clients on these types of arrangements, and just want you guys to be aware that you really need to think about claiming the credit, especially when a firm is pushing you to do so in exchange for a contingency fee. A lot of their, what their business model is volume. So they want to get as many clients signed up as possible, push them to make those claims. They take a portion of it, I've seen anywhere from 15 to 30% of the amount of the credit. And they know that not everyone is going to be audited. So the more volume they get, the higher the benefit that they get. So I just want you to be very cautious if you're approached by any of these firms that are offering to file the credit based upon a contingency. Additionally, we have been able to help clients for much less than that contingency fee, whatever that would be. And so I'd encourage you to talk to your attorney or your accountant before you would sign any contingency fee agreement in this area. Additionally, the IRS is becoming pretty aggressive in pursuing these. They just started commencing audits. We have a couple audits that we're dealing with defending clients on. And the one auditor told me her entire division has been assigned to audit ERC and was told to expect to be on that assignment for at least 2 to 3 years. So I suspect we're going to see an increase in those audits from the IRS here coming very quickly. So let's talk about how you qualify for the ERC. So as I said, there are two standards by which you could meet to become qualified to be an eligible employer. So the first is an objective test, and I'm only going to touch on it quickly because I suspect if you meet this test, you probably have already filed. Nonetheless, if if you meet the test and haven't filed, it's a no-brainer. You should definitely definitely file and claim the credit because, like I said, it's an objective test. There's no real question as to whether or not you would be entitled to the credit. So for 2020, it is that you experienced a 50% decrease in gross receipts compared to the same quarter in 2019. And then in 2021, they decreased the percentage to 20%. So if you have a 20% decrease quarter over quarter from compared to 2019, you would be able to qualify. Additionally, there's a rule that allows you to qualify for the next quarter as well. So for instance, if you qualify for the first quarter of 2021, you will automatically qualify for the second quarter as well. And as I mentioned at the beginning, if you can qualify in 2021, the amounts are higher and per quarter. So that's a really large benefit that can be claimed. Now, the more gray area is the second subjective test, which is a partial suspension of business operations due to a government order. And this is where we see the advisory firms that are out there promoting this really taking aggressive positions. So what I do when consulting with my clients is look for some concrete connection between a government order and specific jobs that you were not able to complete or that were delayed, or some modification to your operations that you needed to make. So I want to give you a couple of real life examples that we've worked with clients on. So we had an HVAC contractor that was not able to do a couple of projects. They were suspended, large government projects, because the customer would not allow them to come into the building. They weren't allowed to have their employees in the building, and they couldn't perform those large projects that were quoted and signed prior to the pandemic occurring. We had a residential home service provider that claimed the credit because due to social distancing orders, they could only have one person in their trucks. Normally they would staff the trucks with 2 or 3 technicians, but because of Ohio's social distancing order, they could only put one person in a truck. So that reduced the efficiency by which they could perform services, because they either needed to have one technician perform a job that normally they would have 2 or 3 on, so it would take longer, or they would have to send 2 or 3 trucks to the same project, and that created inefficiencies because they were limited by the number of trucks they had. Additionally, we had a manufacturer that couldn't have as many employees on the line because of social distancing, and thus their efficiency decreased because they were limited in the amount of employees that they could put within their manufacturing facility. And then the last one I just want to mention is supply chain disruption. So if you were unable to get certain supplies, which I know the construction industry, probably all of you experienced during the pandemic, that could support your eligibility. But the key is you have to tie it to a government order. So maybe your supplier was shut down due to whatever state's orders were in place at the time, or we also had clients that were unable to get supplies because ports were shut down, like the Port of LA, for example, was restricted in the amount of supplies or cargo that they could process on a daily basis. So that created delays. So those are the types of things that you want to be thinking about as to whether or not you qualify. And then Steve is going to talk about some tax savings through 1031 transactions.
Okay, thank you, Rich. And I'm sure most of you have heard about how to avoid tax on the disposition of real property, do a like-kind exchange, and you're probably thinking, well, it's complicated, or I don't want to necessarily find somebody I have to swap my property for, and maybe I don't even want to continue investing in real property. Well, I just want to keep this in front of you because it's such a lucrative area where you don't have to pay tax on the disposition of your property that you've held for investment or use in your trade or business. And this is an area that I've been practicing for more than 30 years and following every development and every kind of planning technique and so forth. And I'm going to share that with you in literally about 4 or 5 minutes here, the essence of like-kind exchanges, so that anytime you have a client or yourself that you're going to be disposing of real property that's appreciated, why pay that tax that could be where you could lose up to 30% potentially, right? A capital gains rate with a state tax and potentially local tax, you're talking easily 30%. And so instead of having $70 or $65 to spend, you'd have $100 to spend on that replacement property and generating an investment return. So you should be thinking of all that additional money that's available to generate a return for you by not paying tax on the disposition of that real property to generate that bigger return on those proceeds. And so what should you be thinking about? This is the most important slide right here, this very first one, and then everything else is going to be filler, just kind of addressing some of the ancillary issues. And I could talk for 5 hours about like-kind exchanges and give you a vomit of information, but what I want to give you is just the essence. And the essence is going to be this first slide here, and then I'm going to share with you some offshoots of this so that you can keep thinking about this. So first of all, you only can do a like-kind exchange if the property that you have is investment property or had been used in your trade or business. Conversely, you can't do a like-kind exchange if it's your inventory. If it's something you're a developer and you bought the property and you knew you were going to sell it, you contemplated an immediate sale after you improved it, then you can't do a like-kind exchange, or you can't do a like-kind exchange with respect to an asset that's held for personal purposes. But there are circumstances that you could have where that's how you might initially hold the property, but you wait a period of time and you convert it to a permissible purpose. So that test that it has to be investment property or use in your trade or business is the test that you must meet at the time you sell it. But property can be converted again from something that had been inventory. Maybe you started leasing it, something that had been a personal use asset, and you may have changed your relationship with that property. So the replacement property also has to meet that criteria, but also you can convert it. Ultimately, something that you buy as investment property could eventually potentially be used for a personal purpose. It just has to be an investment property that you ultimately receive in exchange for your investment property, or and then it can potentially, at the time you acquire it, potentially then it could be converted to something else. So how do you defer the gain? Well, you always have to trade equal or up in value of the property and equity. So that's the next 2 bullet points. So you always have to buy replacement property of equal or greater value, and then you have to spend all the cash that you've received in the transaction. And every dollar you're short on one of those 2 requirements requires you to recognize a corresponding amount of the gain. It's not a proportional. So if I am short 10% of buying sufficient replacement property, does that mean I only have to recognize 10% of my gain? No, that 10% translates into a dollar amount. You're $100,000 short, for example. That means you have to pick up $100,000 of your realized gain. So you always got to trade equal or up in value of the property and equity. And all of this has to occur within a 180-day period. You have to get rid of your property, and then within 180 days, you have to acquire that replacement property. So let's talk about the next slide is some of the things, the nuances associated with like-kind exchanges. must the replacement property be of the same nature? Does it have to be, you sold a commercial property, an office building? Does it have to be another office building? And the answer is no. All real property is of a like kind of a like kind nature, except if it's property that's held outside of the United States. So the replacement property has to be real property in the United States, and all real property is of a like kind. So you could sell your office building and you can buy vacant land in Idaho. It doesn't have to be income producing. Next slide. Must the exchange be simultaneous? Well, anytime you have somebody that wants to give up their property in exchange for your property, that is a simultaneous exchange, but it doesn't have to be. The replacement property just has to be identified. What you do is you sell your relinquished property, you hold it in an escrow, a qualified escrow account with a third party, and it's protected, it's insured. The funds are insured. And then within 45 days of that disposition, you have to identify multiple properties that you may potentially acquire. And then you have to acquire one of those identified properties within 180 days. So it doesn't have to be simultaneous, and it doesn't have to be with the party that you sold your property to. You can sell that office building for $2 million. Funds are held in escrow. And then within 45 days, you identify that replacement property and then potential replacement properties. And there's a separate set of rules concerning that. And then you have to ultimately acquire one of those replacement properties. Next. What if you don't meet this requirement? If you don't acquire a property that you've identified, or if you don't even identify replacement property, then that gain is going to be deferred until you actually receive the funds released from the escrow account. So in other words, it's treated as an installment sale. And if this transaction occurs, let's say in December of a year, then you're automatically going to shift that gain to the subsequent year, because if you don't complete it when you receive those funds, because you don't have any form of receipt of those funds in the year of the sale, because they're held in escrow. If they're released from that escrow because you did not do an exchange in the subsequent year, then that pushes your gain to that subsequent year. Next slide. What if you have a buyer? If a buyer wants immediate possession, but you can't acquire that replacement property for more than 180 days. So you know there's going to be some issues with respect to acquiring your replacement property. There's a couple things you can do. One is you could have your buyer feel confident they're going to be tied to that to your property by leasing it with an option to acquire it. And you know, the option may not be exercisable for a certain period of time. So you want to keep your buyer engaged to tie that property up. Or you know, you could always have, if it's the replacement property, yeah, you could always even have a third party potentially acquire that replacement property and hold it on your behalf, as long as they're subject to risk associated with that property. But the key in this particular question is tying up your buyer, keeping that buyer engaged. And I'm suggesting in this example that it's a lease with giving that buyer an option to acquire the property that's consistent with the timing as to when you can acquire that replacement property within that 180-day period. What if my replacement property must be acquired first? So you have to acquire the replacement property before you sell your relinquished property. There's a whole set of rules that deal with this that are called reverse exchange rules, where you use a blessed third party that acquires that property on your behalf and then holds it for you no longer than 180 days until you sell your relinquished property. And there's a special set of rules that you can even do if you need to go beyond that 180-day period. You could potentially have somebody acquire the property on your behalf and just hold it as a straw party, as long as they have risk of loss associated with that property. And there's some other planning you can do. Next slide. And then you can also construct your replacement property. A whole set of rules concerning constructing that replacement property. Oftentimes it's very difficult because then you have to spend all the money within 180 days of the disposition of your relinquished property. That makes it difficult. I've had transactions where you could potentially even commence the construction of the replacement property through a third party way before you sell your relinquished property. There's a case that came out a few years ago that blesses a transaction. It's not a safe harbor transaction, but you could have potentially 2 years to construct your replacement property before you sell your relinquished property, and use that constructed property that you hold through a third party as your replacement property. Next slide. How about the cash? Sometimes, oftentimes the clients say, well, hey, I want the cash out of this transaction. That's why I'll just pay the tax. I guess I'll keep some cash. And the answer is, well, you got to spend all the cash on the replacement property because, again, you have to maintain your equity. But you can always pull the cash out after you acquire the replacement property through a refinancing, as long as it's independent. So even for those that want the cash, you can pull it back out after you acquire the replacement property. And keep in mind, why pay that tax? You could have potentially 50% more working for you, generating that return by not paying the tax. And then if you have to pull the cash out, you pull the cash out through a refinancing that's independently obtained after you acquire the replacement property. Next slide. What happens? This is a common scenario. You have an entity where you're going to sell this property, you have partners in this LLC, and everybody wants to go their separate way. Clearly, if the entity wanted to continue to invest through the same owners, you could do a like-kind exchange. But if they want to go their separate ways, then what you do is it's special planning you need to do before you actually execute any type of letter of intent or agreement where the members, the partners of the entity, agree to sell their interest in the property to be received in liquidation of the property at closing. So what happens is you can still do a like-kind exchange, but you do it at the partner level, the member level of the LLC, through a constructive liquidation of the property at closing. So it doesn't change anything with respect to how the transaction closes. You just do it by deeming it to be a sale through the owners of the pass-through entity. Next slide. What happens if you don't want to be involved in managing this type of replacement property? You're older, you don't want to do any type of collecting rent and so forth, where there's a lot of different passive investments you can do. You can hold a tenancy in common interest, where you're one of 1,000 owners of a Walmart property or a Walgreens, or it could be, as a tenant in common, owning the property subject to a triple net lease to a Tractor Supply. Or this most recent development is use of Delaware statutory trust, a very sophisticated investment where you just own an interest in this trust, which is deemed to be an interest in real property. And it's almost like owning a dividend paying stock, with a good return, and that's your replacement property. So I just want to keep that in front of you. Next slide. Is it really that simple? Yes, it is. As long as you're going to maintain your investment at the same level and at the same equity level, then you can do these like-kind exchanges and not pay any tax. And the ultimate plan is to die with that property in your estate, where the tax is forever excused because you get a basis step up. Thank you. Thank you for the opportunity to make this presentation. I'm going to hand it back over to Rich.
All right, thanks, Steve. So I'm going to go a little quickly over qualified opportunity zones. We've helped clients, real estate investors, and developers set up these funds to qualify here in Northeast Ohio and actually outside of the state as well. But just a couple things I would like to stress. One is it makes sense to check if you have property that you're developing or rehabbing, if it's in one of these qualified opportunity zones. And so all the larger cities in Northeast Ohio have areas that have been designated, and every county in the state of Ohio has some opportunity zone located in it. This isn't something that I would say would make an investment or a project viable, but if you're already operating or developing property in this area, it makes sense to go ahead and look to see if you are able to qualify. And the two main benefits that I'd like to point out, one is tax-free appreciation. So if you own the qualified opportunity zone investment for at least 10 years, the sale of that investment will be tax-free. And then additionally, Ohio has that's at the federal level. Then Ohio has an additional tax credit that can be claimed by on your individual income tax return, but it can also be sold. So even if you're not a individual investor or a pass-through entity, you have the ability to sell the credit, and that's 10% of the qualified investment for Ohio purposes. I'm going to skip over the qualification because it gets kind of complex, but just know that it's best if you plan ahead of time before you're going to purchase that property or improve the property. And then finally, so the property, at least with respect to real property, must be substantially improved within 30 months of being acquired for it to qualify. So, and what that means is that the basis in the building must be doubled within 30 months. So effectively, you have to invest in capital improvements or development on the property that's equal to the cost of the building. Now, we've done, there's some areas where you can decrease the total price paid based upon allocating a portion of the purchase price to the land or some type of goodwill. So like with respect to a mobile home park, there's goodwill associated with the value of the license to operate a mobile home park. So you can, in that particular case, we allocated a lot of the cost, the acquisition cost to the land and this value of the license. But something to be certainly aware of if you are involved in development or rehabilitation projects. And then we're going to go back to Steve, and he's going to talk about some Ohio sales and use tax saving opportunities. Steve, you are muted.
Thank you, Rich. And Rich and I have a very extensive Ohio sales and use tax practice. And what's nice about the areas that we are speaking is that we have done this for many, many, many years, other than the ERC, because it's just only been around for a short period of time. And we're knee deep into that, as Rich has highlighted. But sales tax. So what do we think of with respect to contractors when it comes to Ohio sales tax? And just as a background, every person, business, or individual that buys tangible personal property has to pay sales tax on that purchase, and use tax is there to complement it when you buy from a vendor located outside of Ohio that doesn't collect Ohio sales tax. This complements the sales tax, use tax at the same rate as the sales tax. And there's certain selected services that are taxable. But so what do we think of when it comes to contractors? Well, there's two areas that I just wanted to highlight for you, and not to bury you with a ton of information. But one is the potential resale exemption. And just as a foundation, the resale exemption, we always think of it in the context of Walmart. Walmart buys its materials from a supplier, and then it turns around and conveys it to the customer. So since Walmart is the vendor and it resold what it purchased, it doesn't have to pay tax on its purchase of those materials or the inventory. And so therefore it collects tax from its customer. because of that subsequent sale, the vendor to the customer. And a sale is defined as a transfer of title or possession, which would include a lease, in exchange for consideration. So how does this arise in the context of a contractor? Next slide. Rich and I were involved in a case that we're really proud of, where that involved a bunch of traffic maintenance property. The temporary property that's purchased for a job, the guardrails, the message boards, the temporary traffic signals. That type of stuff is bought by a contractor. It could be leased by the contractor, and then they turn around and they convey possession of it to the underlying a customer. Most of the time, when it comes to asphalt and paving, it's a public entity. And so we took the position, and the Board of Tax Appeals and Court of Appeals agreed that wait a minute, isn't that contractor selling that traffic maintenance property? It doesn't have to pay tax on the purchase of that property. It's reselling it to the municipality, the state of Ohio, because it's transferred possession in exchange for consideration. It's leasing that property to the state of Ohio or the political subdivision. Again, the Board of Tax Appeals agreed, and it was affirmed by the Court of Appeals. So it's a beautiful decision, because you don't have to pay tax on the purchase of your traffic maintenance property, and you also don't have to collect tax, because normally when you have a subsequent sale to support the resale, then you have to collect tax. Well, in this instance that I've described, since your customer is exempt from tax, the state of Ohio political subdivision, then you don't have to collect tax. It's a clean tax planning technique, because you avoid tax on the purchase of your traffic maintenance property, but you don't have to collect tax on that subsequent resale. So it works beautifully when that ultimate transaction is not taxable. It's actually it could be a hurdle, because if it's a private contract and you have to collect tax on the traffic maintenance property that's used for the private contract, and it's regardless of, that would be the state's position. So just want to bring that to your attention. There could be opportunities there for you to save prospectively, or even refund opportunities. Next slide. The other thing we think of is also involving asphalt roads is, if you're an asphalt producer, can you claim a manufacturing exemption for the production of that asphalt? But holding that for a second, we've encountered lots of asphalt paving companies that have this grinding equipment that takes the layer of the cement off of the surface, the old asphalt, grinds it up, and it's reused or sold to the manufacturer of the asphalt. And so therefore, that equipment would be entitled to the manufacturing exemption. You wouldn't have to pay tax on that very, very expensive grinding equipment. We know it costs hundreds of thousands of dollars, as well as the maintenance costs associated with that, as well as the fuel that's used off-road for that. Very big savings opportunity, as long as you're selling the recycled asphalt. Next slide. But for an asphalt producer, how does an asphalt producer get an exemption? The manufacturing exemption is very powerful, and you get the exemption as long as you're using your equipment to manufacture something for sale. Well, if you're actually paving using your if you're not only producing the asphalt, but paving the road in a separate division of the same entity, then you're not really selling the asphalt, because your paving division is deemed to be consuming the asphalt. You're not selling it. You're not selling it to even the end user. It's a fiction that the state of Ohio, based upon a statutory construction, it says, hey, contractors are deemed consumers of all their materials. So if you're manufacturing your materials and you're a deemed consumer of those materials, then you don't get a manufacturing exemption. The answer is you got to put that asphalt production operation in a separate entity. And that's the next slide. And then you get the manufacturing exemption, but you only want to do that if you get an exemption for the ultimate sale of your asphalt, because that transaction where you're selling the asphalt to your paving company, the related company, that's all of a sudden now a taxable transaction. Yes, the asphalt company on this slide gets the manufacturing exemption because it now has a sale to the paving company, even though it's related, but it also then has to collect that tax on that sale to that paving company. No big deal if the paving company is entitled to an exemption because it's using all of the asphalt for exempt jobs, like for the state of Ohio, political subdivisions and so forth. So planning, good planning that you should be thinking about for purposes of maximizing a potential exemption. Next slide. Then I just want to keep in front of you the relevance of property. I mean, you're probably thinking everything you do is real property. And it may be 100% of, or 95% of what you're doing is real property. But also conversely, there could be personal property components of whatever you're doing. And anything that's personal property, you have a sales tax collection obligation. You could get in a tough position if the state comes in and says that even though everything you're doing is permanently attached with the intent to make it permanent, it's not real property because it's specialized. So you shouldn't have paid tax on your materials as a contractor, as a deemed consumer. You should have, instead, you should have collected tax on your whole sale price because this is personal property. So it's important that you know if something's personal property versus real property. If it's real property, you only pay the tax on the cost of your materials that are incorporated into the real property. And then, of course, if it's real property, whoever owns it pays real estate tax perpetually. But the contractor could get whipsawed. They could pay the tax on all the materials, but the state comes in and says, well, wait, no, that's personal property. You should have collected tax. And we don't have to give you a credit for the tax you erroneously paid on your materials. You have to file a refund claim, and hopefully it's within the 4-year statute of limitations. So how do you protect yourself? Next slide. Is you got to understand what's real property versus personal property. And as a general proposition, the statute says buildings are, fixtures, improvements, and structures are real property. And personal property is something that's a business fixture. Well, what does that mean? Next slide. The critical distinction is if it's something that's primarily geared to a very specific business that a subsequent tenant is not likely to use unless they're engaged in the same type of business, that's really the back of the envelope test. If it's really, really specialized, even if it's permanently attached, if it's really specialized to that business, the state has a pretty strong argument that that's personal property and you got to collect sales tax on that. And on the screen, there are some common elements of a building that are considered not to be business fixtures where you treat it as real property, you only pay tax on your materials. Next slide. So you really want to understand that distinction. There is an argument you can make that if it's something that's fabricated at the site, even if it's specialized, concrete, heavy type of improvement, then that also is real property, but that's a dangerous area. And we just want to point this out to you. Next slide. As a building contractor, you don't have to pay tax on all your materials. There is an exemption for many of the materials and that are tied to these areas where your customer, the ultimate owner of the property, is a government entity, a livestock structure, nonprofits, and so forth. Next slide. So, kind of summarize, you should be thinking about where are there any personal property components of your contract? You can protect yourself by shifting the burden of an erroneous classification to your customer. If your customer tells you in writing before you commence the enter into the, as part of entering into the contract, before you commence the work, the customer tells you that these components are personal property and these are real property, you can rely on that as long as you act consistent with that. Even if the customer says all of this is real property and says that in writing, you can rely on that to protect you from this erroneous classification. And then also keep in mind, again, the exemption for the building materials. Next slide. And then I just further summarize it here. Sometimes it's beneficial. You want something to be personal property because the customer may have an exemption. Perhaps it's something that's really specialized, but it's used for manufacturing. Then you want to say it's personal property. Then the customer will benefit, or you benefit by not paying any sales tax on it because it's used in manufacturing. Another exemption might be available. And you avoid the perpetual real estate tax that would be due. Because, by the way, I'm talking about sales tax planning, but whatever is real property for sales tax purposes is also real property for real estate tax purposes. It's the same definition. So that's what I want to leave you with. I know it's a lot of information, but I just want to keep that topic in front of you, the essence. Thank you.
Great, Steve. Then the last topic that I'm going to talk about is commercial activity tax. And so I've worked with several contractors on planning and just compliance with respect to commercial activity tax, which is particularly harsh on the construction industry because the intent of the tax is to tax each link in the stream of commerce. So there's no deduction or resale exemption for property or services that you're going to be passing on. So when a general contractor collects a large amount for a project, they're going to pay commercial activity tax on that whole amount, even though most of that is going to be paid out to subcontractors. And then the subcontractors are going to have to pay tax on the amount that they receive. And if they have subcontractors, then the subcontractors are going to have to pay. So it's really a pyramiding of the tax. Now, how they justified this when the commercial activity tax was put in place is they referred to it as this broad-based low rate tax. So it's only 0.25%, but when you're talking about millions or tens of millions of dollars included in a project that are essentially passed through to subcontractors, then that can become a very material aspect of the cost of the project. One other thing to understand about commercial activity tax is that commonly owned taxpayers, and that means that you have a single person or entity that has at least 50% common control must file as a combined group or can make an election to file as a consolidated group. And the consolidated election becomes very important because you get to exclude intercompany transactions. So the example that Steve gave with respect to the asphalt company, where you have a separate company that manufactures the asphalt and then sells to the paving company, in that particular instance, it's very important to make a consolidated election so that the manufacturing company does not have to pay tax on the gross receipts or the sales it receives from the related paving company. So in that example that Steve gave, there's actually two savings that you can realize. One is the manufacturing exemption on your purchase of equipment to manufacture the asphalt. Secondly, there's a commercial activity tax savings by having that structure and making a consolidated election. So one change that commercial activity tax put into place was it's based upon your gross receipts are sourced based upon where your customer is located. So it doesn't matter if you are based in Ohio and perform services or perform the project in Ohio, your gross receipts are going to be taxable only if they are sold to an Ohio customer. So for tangible personal property, that's going to be if you deliver items to, if you deliver the item or it's received by the customer in Ohio after all transportation is completed. However, I think more importantly for construction contractors is the sale of services. So sales of services are sourced to the location where the customer receives the benefit of the service. So that's really easy when you're providing services to real property. So, real property construction is going to be sourced to the location of the real property. That's where the customer receives the benefit of the service. It's a little, or there can be more gray area with respect to providing like professional services. So design, architectural, engineering type services that a contractor may provide to customers for projects outside of Ohio. All that service revenue is going to be excluded from your tax base for commercial activity tax. So you want to be aware if you're performing services or projects outside Ohio that you're properly sourcing those gross receipts. Additionally, that this technique or exclusion from gross receipts is very helpful for contractors in certain relationships. So it's called the agent exclusion. So property or money that's received by an agent and then paid out or passed through to the ultimate person who's entitled to that money, that amount is excluded except for the agent's commission or fee that they keep. So how does that play? I'm going to explain how that plays into effect with respect to a contracting situation. But what you need to understand is that to make it the best set of facts, you should have a contract that expresses this agency relationship, because the tax commissioner is going to assume that there's no agency relationship unless it's explicit in the contract. And then I want to talk about some of the aspects of an agency relationship that both the agent, in this case it would be the contractor, and the principal, so that would be the property owner, have to be aware of. One, the agent has to be prepared to act in the principal's best interest. Additionally, the agent the agent is able to bind the principal. So think of a material purchase. If the contractor is acting as an agent of the property owner, and the contractor does not pay for those materials for whatever reason, goes out of business, goes into bankruptcy, then the principal, the property owner, would ultimately be responsible for that. And then there's this final element of control. However, they just have to have the right to control the agent. Obviously, the principal does not need to, tell the agent, on a daily basis how to perform the construction project. So there's an example in the rule that can be really beneficial to construction contractors, and the example is with respect to a general contractor. So if a general contractor enters into a cost plus contract with the property owner, and they are acting as the property owner's agent when they contract out with subs or purchase materials, then they're able to exclude the amount that passes through the general contractor as a conduit. So, let's say if you have a $10 million contract and but the general contractor is only going to retain a small portion of it as its fee. If there's no agency relationship, they have to pay tax on the full $10 million of receipts that they receive for that project. However, if they're acting as an agent for the property owner by going out and securing subcontracts and purchasing materials, and like I said, the property owner is ultimately on the hook for those purchases if the general contractor does not pay, then the general contractor gets to exclude all the gross receipts or amounts it receives that are ultimately paid out to the subs or for materials. Now, a lot of times property owners or general contractors in this situation will be like, I don't want to accept that responsibility in case another party doesn't pay for that. But in this case, due to mechanics liens, really the property owner is going to be on the hook for those amounts anyway. So it doesn't really add any significant increased exposure. And that's why obviously you get mechanics liens waivers prior to the final payment, is to protect against that contractor that does not pay a subcontractor. So on very large projects, you know, the tax rate is 0.26%. So on $1 million, that's $2,600 basically is what you're saving. So it doesn't make sense to do it on smaller projects, but when you can exclude, you know, tens of millions of dollars under this agency exclusion, it certainly can, you know, make it very much more beneficial to the general contractor. And normally, you know, in my experience, the property owner, because it's a reduced cost of the project, typically is willing to kind of appease and cooperate with getting the proper contract in place to be able to claim this agency exclusion. All right, so as we wrap up here, I want to thank everyone for attending, and want to thank John and Tim for the opportunity. Like I said, our contact information is on this last slide here. Really do, you know, encourage you guys, if you have questions, feel free to reach out to Steve or I. We would be happy to talk through and see if there's anything that we can help you with on the tax saving side. As John mentioned at the beginning, we really love to help our clients put more money in our pocket, or in their pocket. That's the most fun part of our job. So I'll turn it over to John to just close up real quickly. Thank you again.
Thank you, Rich. And thank you, everybody, for spending the time with us. Tim, thank you for letting us have the opportunity to speak to your members. Have a great day, everybody. Tim, do you have any follow-up? Yep.
And we will be sending around the slides to everybody who registered, and the video will go out in Tuesday morning's bulletin. So thanks again, everyone.
Thank you.
Have a great day.